Hey everyone, good to be with you. Had a bit of a technical glitch there, so we're broadcasting live on the live channel, not on the normal pre-posted channel. So sorry if you didn't get your alert for this, and hope you're enjoying your summer. We're coming to you today with some ideas about how you can supercharge your balanced portfolio. We've been talking about a number of different things that you can do to manage all sorts of things in your finances to get better value over the last weeks. So today we're looking at how you can take your balanced portfolio and do a little better with it. And so what I want to do is we're just going to get right into it. This is not going to be long and complicated, but it's a powerful idea for how you can significantly increase the results in your balanced portfolio without taking any additional risk. Now, you may know that we're more advocates of what we would call the unbalanced portfolio, 100% equities. But a lot of people prefer something they feel is a little less volatile, less risk prone. If you've been paying attention this year, if you were in 100% equities, and I'm talking about a mixed portfolio there, but 100% equities, you're talking about probably having lost 20 to 22, 23% in the first part of this year, although there's been a recovery going on. I don't know if that's going to last, if we're still in a bear market or what's going to happen, but things have turned up. So what was once down maybe 23% is down probably half that right now. But if you prefer not to go on that kind of a ride, if you prefer something with a little less excitement, and although it will yield a little lower returns, you've probably opted for balanced portfolios. In fact, most Canadians are in balanced portfolios, whether they know it or not, primarily because they go and get their advice over the counter at the bank, which, by the way, isn't advice at all. It's just a sales pitch. But the number one funds that are offered by all the financial institutions are their Canadian balanced funds. Why is that? Well, because that keeps them out of trouble. They don't have to think about it. People fill out these forms that are so-called risk tolerance forms, which really isn't what they are. But they invariably point to getting the balanced portfolio that's put together by whichever institution you unfortunately walked into the door of. But however, if you are inclined toward a balanced portfolio, you can do significantly better than what you've been doing without taking any additional risk, and I would argue with taking less risk. So let's just jump right into it. So here we see our typical balanced portfolio. So the pink line here is actually, now I'm talking strictly Canadian stocks inside of mutual funds right now. So just to try to keep it apples to apples comparisons. So the pink line represents if you were in a 100% Canadian equity portfolio, what would have happened over the last 10 years. This is an all equity portfolio. And it's an ETF, so it's very low on the expenses. So if you had been in that portfolio for the last 10 years, you started over on the left here with $100,000, the all equity portfolio would have grown to about doubled, $200,934 over the 10 years. Now, what we see in this green line, so your typical balanced portfolio would only have 60% of these equities, so 60% of that pink line. And it would have 40%, those are the typical numbers, 60-40, of this dotted green line. And this dotted green line, we move along here, again starts at 100,000, but it's only gone up to 123,986. So let's call it 124,000. So over 10 years, it's only gone up a total of 24%, whereas the equities have gone up 100%. They've doubled. So what that means for your Canadian balanced portfolio that's 60% of the pink line and 40% of the green line is what happened on this blue line. This is a Canadian balanced portfolio 60-40. And so it's gone up to 167,000. So, a 67% increase over 10 years. That actually, the way we normally talk about things is average annualized returns. The average annualized return of that balanced portfolio has been 5.89% over the last 10 years. So, not completely awful, but the difference between getting 6%, that's almost 6%, and getting 9%, which you might get in a well-constructed equity portfolio, that has enormous power and implications over the long term. It's not just that you would do 50% better, you would do much, much better. So let's look at what we might do, because the idea behind our bond portfolio is to provide some steadiness, to reduce the volatility. And you can see, yes, the blue line is a little less volatile, but it still goes down in the significant downturns, but not to the same extent. Also doesn't go up as much during the peaks. So if we look at our bond index, here's what the returns have been on the bond index. And so we can see here that, let's just look at the 10-year number. Since inception is longer. I'm not sure exactly how long it is for this bond index fund. But for the 10-year result, it's been about 1.82. And over the last 20 years, that's been about the result of the Canadian bond market, is returned about 2%. And so that's, it's provided some growth, but it hasn't been as steady as you might have liked, because the 1-year return on it is down 9%, and the year-to-date return, where our equity performance is down about maybe 11% or 10%, perhaps even less, the year-to-date on the bond market is down 9%. So it really hasn't provided that much stabilization to the balanced portfolio in the way that you might hope. So we've been looking for alternatives, and we found them looking at the whole life insurance market. Now, just to clarify what I'm suggesting here, it's not that, you should put all your investments into a whole life insurance product. That's not at all what I think you should do, nor do we recommend that. But what if we look at how they've been performing, how the returns have been on the cash portions of these insurance policies, these whole life insurance policies. And so these folks are conservative money managers, and they have a pretty well-established, extensive track record of good returns. So this particular one I'm looking at is for Equitable Life. Different insurance companies have different participating accounts. The participating account is a portfolio that's run by the insurance company. And those people who hold whole life insurance policies participate in that account, as the name suggests. And so it's comprised of bonds, 34% bonds, but it's got some conservative equities in it, some real estate, some private placements, policy loans, which are a solid gold source of returns for them, and they do mortgage lending as well. Now, these have been around for many, many decades, in Equitable Life's case since the 1930s. And so what they do is they pay an annual dividend. That's the return that you get on your participating account portion inside your plan. Now, that dividend currently is paying at 6.05%, but it's been higher previously. So let's take a look at how it's been over longer periods of time, perhaps. So if we look at the historical dividend scale, and so this would be equal to calendar year returns here. You can see it's at 6.05. It was that in 2021. It's that again in 2022. 2020, it was 6.2. Back to 2017, it was as high as 6.5. But if we look historically, it's been significantly higher. So 6.26 is the 5-year average. But if we go to the 20-year average, it's 7.19, and the 30-year average is 8.02. So it's delivered some pretty solid returns. And what we really want to compare it with is what's been going on in like comparable, what I would call conservative investments. So you've got, for example, your Government of Canada bonds, 5 to 10-year bonds. When this was at 8.02, the Canada government bonds were doing 3.95, and the 5-year GIC has been doing 3.35. So you can see that we get a significantly better rate of return out of the funds invested inside the cash portion of these policies. And we can look even further back. Let's look at our 30-year returns here. So if we go back to 1992, they were returning 10.7%. At that time, government bonds were doing 8. GICs were doing 7.8. Yes, they really were doing 7.8 back then. It's been a long time since we've seen that. But they have been delivering returns. Here's the true major upside to this. Let's go back and look at our line graph here. Okay, so this is the return. Let me make that a little bigger. There we go. This is the return comparing the different investment types. Now, again, this is only 30 years. And bear in mind that Equitable's been delivering returns. Every single year, they have delivered positive returns from their fund since the 1930s, since it was first established in the 1930s. So our red line here is the TSX equity index. So you can see why some people might not like the volatility of that ride. There's a lot of spread. We see in 2008, the TSX fell about 34%. But then the next year, it was up about 34% or 35%. So it's delivered a reasonable rate of return, but it's quite volatile. What we see here, the green line and the kind of light blue or turquoise line here, those are GIC and Government of Canada bonds. The gold line here is the Equitable dividend scale rate. So comparing that, we see that it's definitely a smooth ride. Not a lot of volatility, but it's a much better ride than what we're being given from the government bonds and from the GICs. So we know that over the last 20 years, from a Canadian bond index, we've averaged about a 2% rate of return, about 2.1. But yet over the last 10 years, this Equitable fund has returned 6.5. Now here's a couple of things to note. I keep mentioning that they have not failed to provide a positive return in about 90 years, every year. But even more significantly is there's no way for that investment to go down. The worst thing that could happen is that they would not provide a dividend in a given year. Now, if they didn't do that, that would mean your return for the year was 0. But that's the worst that can ever be. It can never be worse than 0. It can never go backwards. Whereas our bond index, our bond funds, because they contain corporate bonds and the value of bonds shifts. As we saw, our bond fund for the last year, our bond index for Canada, has gone down 9%. So what we look at is, okay, well, what if we were, instead of using a traditional balanced fund to provide our ballast here, if instead we swapped out this kind of dismal performing green line and added in and took our money that we're putting into bonds and instead put it inside a whole life plan so that we're taking advantage of those 6% rates of return. Now, to clarify, you're not going to get 6% on every dollar you put into the insurance plan, because a portion of the insurance plan has to go to paying the cost of the insurance. So out of that, you might net a little over 4%. And in fact, we had that here. Let me just pull that up. All right, let's find that. We did have that pulled up before, but in our technical problems, when we tried to start the show, I guess it sank beneath the waves. All right, here we go. Okay, let's bring that back. Okay, so this is just a comparison where we looked at if we were to put our money in here. So this is comparing putting $40,000 over 8 years, so $5,000 a year, into the whole life plan versus putting it into the bond fund. And we can find the summary here. So here's the comparison. So if that $40,000 going in, we see here at the beginning, they track relatively the same. The green line is the bond fund, and the dark blue line is the whole life fund. But what we find is over time, they begin to separate out. And that's because the insurance is fully paid for, and everything is now growing at that 6 to 8% rate, or whatever return is being provided through the dividend, the annual dividends. And so over the long period, after about 15 years, things start to really spread out. And you'll see that, let's say, if we look at retirement, that we're at about 80,000 in cash value versus 50,000 in the bond fund. So we're already about, what's that? 50. We're about 60% better in our return. But as time goes on, assuming we're not using that money up, we get out to life expectancy here, and our cash value has grown to 261,000, whereas our bond fund is now only at 70,000. And that's partly because of the way the bond is taxed. Whereas the the growth inside the insurance plan is not taxed. And if you were to die at that point, at life expectancy, that would be returning only $70,000 to your heirs, whereas the cash value, the total insurance benefit in this plan actually exceeds the cash value, and it would be about $325,000. So more than 4 times as much if you go right out to death benefit. But if you're using the funds, you have 200,000 to use as opposed to 67,000 to use. So this, again, not the place for your 100% of your investing for a number of reasons. Primarily because you want to have the horsepower that equities are going to provide in your retirement portfolio. But if you're looking for balance, if you're looking for some stability, then this can be a very powerful way to add that stability without taking the hit, kind of the penalty that we take when we use these bond funds, which really have not been performing well over a long period of time now. And given the interest rate environment, are not particularly likely to do a whole lot better in the near term. And again, we can anticipate, I think, a fair bit of volatility going forward, which is not which is not abnormal. That's just how the markets are. But being inside one of these whole life plans can give a portion of your wealth a very stable, tax-sheltered ride, and also, if it pays out as a death benefit, a tax-free disbursement of the entire growth on your death, whether that's going to your family, your children, your grandchildren, or your charities, whatever you name as your beneficiary. So that gives you an idea of, I think, a powerful option for supercharging your balanced portfolio. And we've helped a number of people with this now, and people are enjoying the very positive results of it. So if you're interested in knowing more about this, send us a message. We're happy to send you information. If you'd like to book a time, you can book a time with me. I'm happy to spend 15 to 30 minutes just to introduce the concept and chat with you and see where you're at, to see if this might be a fit for you. It's not for everybody. It's not for every plan, but for the people that it works for, it can be a great source for supercharging your balanced portfolio, giving you a better return with less risk than you're even taking in your balanced portfolio. And I'm going to put the location there where you can book an appointment if you want to have a chat about that, or drop us an email. Always happy to respond to your questions and emails. One other option is you could subscribe to our newsletter, which goes out weekly and will keep you apprised of all these tips and tricks. The links to these videos are in there, as well as information about what's coming up on our upcoming broadcasts, and links to a lot of what we've done previously and lots of other great information. You can do that at go.getthesimpleplan.com/subscribe. There you go. Put that up on your screen. And we'd love to have you join that. That information goes out every week, and it's really full of great stuff, and keeps you apprised of, we've got some upcoming webinars that we're looking at doing. In fact, we have a contest going on right now as well, where you can win one of, must be 20 great books that can help you, your pick from that little library of great books that can help you with your finances, with building your knowledge about things, with your habits, or anything else. So it's been great to be with you. Look forward to next week. And again, subscribe to our newsletter and you can keep track of what's going on. And I look forward to seeing you again next week. Bye for now.